What is up today, guys? Andrew MacLeod here. Special guest on the show, Mike Habib from RBC. We're going to be talking about financing tips, anywhere from down payments, credit score, and some of the new products that RBC has. Mike, happy to have you here.
Same here. Thank you. I greatly appreciate the invitation, and I'm pretty sure your listeners will have a great value out of this conversation. And hopefully we'll be able to help everybody who's looking for mortgages, also for looking for a good real estate agent to work with.
Oh, that'd be awesome. No, I think me and Mike kind of sat down and put a list of questions together, and I think it's going to be an action-packed show. So, Mike, why don't you start by just kind of telling the audience maybe a little bit about yourself and, I don't know, maybe how you got started and kind of where you're at now?
Absolutely. My name is Michael Habib. I'm a senior mobile mortgage specialist with Royal Bank RBC. I've been with RBC for 18 years. Actually, when the regional manager picked me for this role, I had no banking background or anything like that. I used to work actually in Caesars Windsor as a supervisor and game security team.
Wow.
So she wanted somebody who speaks French and Arabic, looking for somebody, and interviewed me, and she liked me for the job. So since then, I became a mortgage specialist and doing greatly well. On my third year, actually, was RBC. I started winning the convention, which is the top 80 in the country. And
that's pretty good.
Yeah, and it's been ongoing since then, like 13 years in a row, being like one of the convention winners. And in the last 4 years, actually, been a chairman, top 1% in the country. So I'm really proud to say I work for such a great institution, the most ethical financial institution in Canada and in North America for a few years in a row. Nobody needs, when you approach people saying that you represent RBC, you don't need to do more introduction. Everybody knows Royal Bank RBC and such a great institution. So very proud and lucky enough to be doing so well in such a great community like the Windsor and Essex County. It's been like very rewarding working for this community city we work for.
Yeah, that's actually amazing. I know like a lot of people are like, oh, Windsor, but I mean, there's a lot of people, and you know what? Everyone's great in Windsor, and I think you guys do a great job. And yeah, everyone knows RBC.
Absolutely. And as I said, we are very proud to work for such an amazing ethical financial institution. And they stepped out like for the community huge during the pandemic. And I'm very, very proud to work for such an amazing financial institution.
That's awesome. So Mike, how do you feel like, so right now, as like me being a realtor, we kind of see the market softening a little bit. And I know the stress test went up a little bit. How do you feel from like a pre-approval standpoint, or, just how do you feel in general about the market?
To be honest, was the second stress test. Actually, the first stress test was 3-4 years ago. And now this stress that it was introduced in June 1st to cover conventional and high ratio mortgages together. I feel like the market needed an excuse to just like really have a break a little bit. And the last time they introduced the stress test as well, the market was going amazingly good, and then it stopped for a few weeks, just as how can I say? I call it excuse, but I don't know how to call it, to be honest. It's just to have a break on the market.
Yeah.
Gonna kick off again. Actually, it hasn't slowed down that much. From a pre-approval perspective, having the stress test actually maybe will throw another alert for the client that, to revisit their financial institution or their mortgage people to double check on how much they qualify for, because this new stress test may reduce their purchasing level, like not much, but it would reduce it. So my recommendation would be always have, be pre-approved so you can shop with confidence. And if you were pre-approved before June 1st, revisit your financial institution and try to check the numbers again, how much you would qualify for, because again, the stress test may have impacted their pre-approval limit.
Okay. Yeah, I remember. So Mike been on a couple of our meetings at Jump, and I think you mentioned you had about 270 pre-approvals out there or something. Is it kind of this like a similar number, or?
Actually, yeah, my pipeline of pre-approvals. I have a little bit over 270 clients are pre-approved. So I work with
Wow.
4 people. I have 3 people that help me on my team, and we revisited almost every person that we had pre-approved before to mention to them that there is a stress test. This is gonna be revising, our previous conversation for the pre-approval, and we set another appointment to revisit with them their pre-approval, so they will be prepared again, going fresh in the market,
Mhm.
feel confident when they start shopping for their home.
Yeah, that's awesome. And I know, like from an agent perspective, like when an offer comes in from RBC, or sorry, financed by RBC, like everyone has a lot of confidence in that offer to close, right?
Absolutely, because when we do pre-approval for our clients, we make sure we have all the documents necessary, or inform the client to properly about what they're gonna encounter, and we try to
Mm.
have everything on file prematurely, so the client will be confident when they go shopping. Sometimes the client may like not have some documents, but then we inform
Mhm.
that you are pre-approvals as long as we have this document that states what you're telling me, your income or your credit or the down payment.
Okay, that's awesome. So now I know RBC, you guys have a couple promotions right now, right? I think it's a July spring promotion or something. Do you want to explain maybe a little bit about that?
We have actually 2 promotions going. The first one is a switch for free promotion, which is people who have financial difficulties, and they have enough equity in their homes, and they like to switch from
Mhm.
financial institutions to RBC. We have a promotion that we pretty much cover all the costs except the penalty. We cover the processing fees, appraisal fees, legal fees, and discharge fees from the other financial institution, and we try to
Mhm.
to the client as long as they have equity in their properties. All those fees are covered by RBC, except again for the
The
prepayment.
penalty.
Okay,
So
and
what?
we have a new promotion
Sorry.
as well. The new purchases, for whoever not first time home buyer, any purchase,
Mhm.
investment property, second property, third property, any purchases, uh, there is a cash offer on the table. Any purchase 100 to 300,000, they got $500 cash. 300,000 up to 500, they got 1,000 cash. 500 to 750, 1,500 in cash. Over 750,000, they got $2,500 cash. And
That's pretty good.
yeah, this promotion is still on until July 31st. As long as we do the application before July 31st, they would qualify, as long as they qualify before December 31st.
Okay, so as long as I like, if I'm going to buy a house, as long as I get my application to you before the 31st, then we're all good to go.
Correct. Before July 31st, we're good to go. They would qualify, and they would have, 120 days to close, or until December 31st, whichever comes first.
Okay, cool. I had no idea about that. Now, something I always get asked about, and sometimes I don't know the answer to it. I think you'd be a good person to ask this. Is when it comes to credit score, how does that affect, where my pre-approval is going to be, or how much I'm going to be approved for?
A great question, Andrew, actually, because the credit plays big role in confidence in the lenders and the client.
Okay.
Because as you know, the credit bureau report is basically tracking the credit or repayment history of the client, how they repay their debt, any kind of credit they borrow, car loan, student loan, line of credit,
Hmm.
or other mortgages. Okay, they track the payment monthly basis. So that's an indication for the financial institution how these people treat their debt. Are they comfortable paying their debt? Do they pay their debt? They don't pay their debt. So to speak, to make it more simple to the people who are listening to this conversation, is if
Hmm.
somebody borrows money from you and give you a hard time to give you the money back, or not give you the money back, and at all, would you lend them more money? So that's
Probably not.
credit. It's a repayment history for the financial institution to see if they can trust that person to give them more money or larger amount of money or not.
Okay.
So that's why it's a big factor of the lending process and the pre-approval process.
Hmm. So what is the minimum credit score currently right now to
The
get approved for a mortgage?
minimum 300 point to 900. 300 being the lowest, 900 being the highest. Anything
Hmm.
as per CMHC, which is the default insurance company, they would, they wouldn't consider anybody for insured lending who scores less than 680. Unlike
Okay.
unlike the other two providers for the default insurance, which is Seagon and Canada Guarantee, they would accept over 620 or sometimes 600. It depends on the business case. So anything over 6 would be in the okay area. Anything over 750, it's a good area to be the beacon score for the credit bureau report. But don't let that really stop you, because we always can make business case. If somebody has one incident and we can make like really a good business case for it, like somebody had a surgery, somebody had an accident that prevent them from paying the debt. You can make a good business cases like everything else and over.
Yeah.
So we don't want the people, when they see their credit score, to say, "Oh, I won't qualify," or "I don't qualify." Don't contact us, and then we can look at the incident and see what the reason is and try to make a business case.
Yeah. Okay. Yeah. No. Awesome. Yeah. Because well, you're right. Everyone's case is different, right? And I think if you're out there in the market to buy a house, don't let your credit score kind of put you down, or maybe not go ahead with even trying to get pre-approved.
As it is another good reason actually for the people to do pre-approval ahead of time, because through the pre-approval we can tell them what we need to do and how to overcome that.
Okay, cool. Now, what's the difference between, I always get this, high ratio mortgage and conventional mortgage, and what are the benefits, would you say, of maybe either one?
It's very, very actually common question that we get asked. When we say high ratio, that means people putting less than 20% down payment, and we call that insured mortgage. So people can, and again, I wanna specify something here. Not only first-time home buyers. You don't have to be first-time home buyer to qualify to put 5% down payment. As long as you're purchasing the property for principal use, you can go with 5% down payment, or 10 or 15. But the 5%. Lots of people are under the impression that if you buy a house, you sell it, you want to buy another one, you need more down payment. That's not true. You can, as long as the property is for principal use, you can go as low as 5% down payment. And when we go less than 20% down payment, okay, it's called high ratio or insured mortgage. Meaning we require default insurance company involved, and there is a premium cost to that. The premium cost most of the time is covered by the bank, but it's added to the client's mortgage amount. So it gets payment. It's not paid by the bank. It's paid temporarily by the bank and added to the mortgage. But the client can choose to pay it on the closing if they they want to. I've never encountered that, but it is an option. Okay.
Yeah.
Financial institution, when they pay that money, they add it to the mortgage and it gets amortized with the mortgage. Now, if you put 5% down payment, the insurance premium on the outstanding balance would be 4%. If you put 10%, it goes down to 3.1. If you put 15%, it's 2.8%. That amount of the insurance premium cost is 8% PST cost, government taxes.
Oh, wow. Okay. Now, how does it work? Like let's say I'm a first-time home buyer and my grandparents give me the down payment for the house, or is there different ways to do that? I've heard you can borrow from your RRSPs too.
Yeah.
How does down payment work?
Well, the down payment, there is different sources of down payment. Okay. First thing is, if the property is purchased for principal use, then you can use your own money. You can use borrowed money, gifted money. Gifted money means when the people who are gifting you the money, they don't want it back. That's what gifted money means. There is a gift letter form. It clearly states on the gift letter that that money is gifted to you by immediate parents, grandparents, sister, brother, son, daughter. Okay, it has to be immediate. Okay, but they're not going to ask for it back. That can be used the down payment. The other source of the down payment could be your own money, your own investment, or if you have a secure line of credit against another property, you can use those funds as a down payment. Okay. Now, the gifted down payment doesn't apply for a few products, like self-employed person and using stated income. I think there is one of the questions that touched that. Okay.
Yeah.
Stated income, will explain that soon. You cannot use gifted money. It has to be your money from your own sources.
Okay.
Now, if you sell a car, you sell a jewelry, you sell another house, or if you have cash investment, as long as we can verify the down payment source, we are okay with it. If the source of the funds coming from your own source, we require 90 days history on the source of the down payment for anti-money laundering regulations.
Right. Yeah. So that's just standard then.
Yes.
Okay. Okay. Now, when you like, let's say I came to you, Mike, I get my pre-approval. How long am I able to basically shop in the market with that pre-approval, or how long is it good for?
That's a great question, because lots of people, again, get mixed up between pre-approval and rate commitment. And really allow me to explain a little bit about the rate commitment so people understand.
Yeah, go ahead.
Rate commitment means when the bank offer you a rate at the date of the application, they commit to that rate as worst case scenario, because if the rate drops during that shopping time, okay, your rate, if it goes up, you're capped at that rate. That's why it's called rate commitment. And because the financial institution don't print money to give you money, they're not the
right.
They borrow the funds from other investors, from Bank of Canada, from Canadian bonds to give you that money. When we do the pre-approval application, the banks have to hedge the money, meaning put it aside. Okay. Put it aside forever for that client to find a house. That's why we specify 120 days rate commitment. So as long as you find a house within that 120 days from the day of the application, you're guaranteed that rate or better, because if the rate drops, you get the lower rate. Now, what happens after 120 days, you don't find a property, we contact you and we can renew that. But at that time, because that money is hedged, it's not going to be hedged forever. So we revisit in 120 days if the client hasn't found a property to offer whatever the new rate is. It could be better, it could be worse, but another 100.
Right. Okay, that's cool. So yeah, I think 120 days should be plenty of time to find a house. But I mean, you know, when the market's hot, it can be tricky. So it's good to know that you could always go back, maybe possibly revisit it, and obviously redo it.
On my team, we actually contact the clients. We contact the client after 60 days, after 90 days, and 120 days to stay in touch with the client and update profiles if needed. Now, that being said, the pre-approval, when we do the pre-approval, it's good for 120 days. However, we can renew the 120 days on the pre-approval as long as nothing of the financial situation of the client changed. Nothing is the pre-approval, except if something like what happened right now was the stress test. So the stress test, back your previous pre-approval, it's a grandfather until 120 days. After 120 days, what's going to happen? We have to renew it and now follow the new rules.
Okay, so it's almost, if you had it before the stress test change, it would have been better to try and get your house purchase done then, as opposed to maybe coming back and revisiting it and having less purchasing power.
As long as the clients, when they stick to the pre-approval amount or less. If they approval amount by $1, we have to.
Right. Okay. Now, how does it work? I think this is a really good question. What is pre-qualification versus the pre-approval? What is the difference in that?
Personally, I don't see a difference, because I do the pre-approval. I don't do pre-qualification. Pre-qualification is what we call it, like fast path, quick application based on income and expenses, to give you an idea how much you can qualify for, but it's not specifically full application with with all the documents in place. So I would stick to the pre-approval. Okay. Make sure the client are solid. Now, lots of clients comes to me. They don't want me to get their personal information. They don't want me to check their credit bureau, and they don't want to show you documents. So at this point, I make so much, how much I qualify for. I have a quick calculator to do that, and people have access to that online as well. But if they prefer talking to me, I can do that math to them and tell them. But again, when they give you verbal information, you cannot commit to anything, because it's only story now. Until you have documents. And lots of times it would be like really transparent story by the client, because the client don't know that if they're using overtime, we need 2 years average. They don't know if if they're starting with the job 6 months ago, even if they're working 50 hours a week, we're going to take only the base hours of 40, because they don't have they don't know all this information. To them, they're working 50 hours a week. That's their income, and that's the number they're going to give you. So how that number is not accurate. That's why when we do pre-qualifying based only on numbers, we tell the client, this is not really official, this is not really solid, and we cannot commit to that. This is just for general information.
Right. Yeah. So it almost seems better just to go the full route do everything and then you know for sure. Because I've even had some clients that, you know, they go to do that whole process and then they actually got less than what they thought because the overtime hours
Exactly.
weren't actually included. Yeah.
And lots of times people working through like different sources of income, if they don't have full-time position, they think they're working full-time out, but they're permanent part-time, have guaranteed hours. We go with the guaranteed hours unless we have 2 years of average. Similar story in here. Lots of people intend to look at the higher numbers while we look at the actual accurate numbers and be more conservative. Because when you give the client a certificate or letter to tell them you go and shop for this price, that's a commitment. That's a commitment from our end. We want to make sure when they go shop for a house, they're shopping with confidence. They know that those funds. That's why it's always better to have full pre-approval. And even I don't know if that was you or somebody else from your office, Andrew. They sent me refusing me to check their credit bureau, and they gave me verbal email with their numbers. So I told the agent, this is only like really premature because I don't have any documents, and don't take it from me. It's just based on the numbers and figures that the client gave me. That's what came out. So I wouldn't count on it unless you have something in writing, and they're not going to get anything in writing unless we have all the documents in place.
Right. So basically, yeah, get your documents in place, go the full way, and just get it done. That way, you know how much you can spend.
Absolutely, because again, you are an agent and very good one. You know, okay.
I appreciate that, Mike.
No, absolutely. I see what you're doing, Andrew, and I would recommend you to anybody. Okay. But when you go and meet a client and start like really investing time and energy with that client, their time and your time, the listing agent's time and the seller's time, and everybody's time, to go and start shopping with them based on a verbal, assumption from the client, and you go to an offer that they like, and maybe that property land on them. Now they don't qualify. How does this make everybody look like? Especially in a market. You have to be prepared. So my advice to everybody, I know nobody wants their credit to be checked too many times. Go shop, ask for financial institution, what they offer, what they do, what's their service. Look at the package. When you decide, go and do your application with one institution. So your credit's going to be checked only once. And buying a house deserves, to have your credit, checked once.
So, yeah, you have to do it. There's no way you can avoid it.
Yeah, and then once you do that, you're confident you're gonna get the funds. Your agent is confident with you, and you know what? I don't know if you have encountered, but lots of listing agent will ask you who your pre-approval was done with, and there is
all the time.
Mortgage people and mortgage companies are very trusted in the in this market. And when the listing agent hears, I'm not gonna say about myself, but thank God, but let's say a friend of mine or X or Y, did that pre-approval mortgage, the listing agent might feel more confident. Yeah, I know them. They're trusted, and we're good to go. And they'll give you better opportunity than everybody else.
I agree with that. Yep. No, for sure. If you're at the offer table and let's just say you're with Mike, he's a trusted guy in the community. He's awesome at his job. And the agent hears that, they go, well, this is great news, right?
Yeah, they feel more confident because they know we don't anybody's time and waste our own time.
Yeah, that's awesome. Now, this is something that's been going on. The market is obviously, is extremely heated. People they own their house, right? They've had it. They have a lot of equity in it. Maybe they purchased it, say 4 or 5 years ago. Now they want to go buy something else and sell the house that they're in. How do you recommend going about that? Because most people are usually buying first because it's really easy to sell, right?
Yeah, which is a great point, but it's very confusing. Now, if it was me, wouldn't I want to know how much money I'm going to get out of that property that I'm selling before I see how much I qualify for? Because the down payment from the proceeds of the sale of that property is going to play a big role on how much you can buy.
Right.
And how far you can go. If your house is not sold, it's very hard to tell. Then we're going to and assume and work based on those numbers. But the big surprise would be if that house doesn't sell at the value that you want it to sell at. Now you're short on your down payment. That could impact the whole process.
Yeah, it seems really tricky, right? Because some people are, reluctant to kind of sell first, because they know it'll sell fast, and then they're worried, oh my God, I'm going to have 90 days or 60 days to figure out how I'm going to find my next house.
The perfect situation would be, finding a house, and if you can put a condition on the sale of your house, would be great.
Yeah.
But most sellers won't accept that because they don't want to, hold their property based on somebody else's, like looking for a price that maybe they'll get or maybe they won't. So that's why
Yeah.
it's complicated. But personally, if people have that luxury to sell first, to know the exact numbers they're gonna get from the proceeds, how much consolidation of debt we can do, and how much proceeds we get, net proceeds, to say we're gonna have, this would impact how much money you would qualify for, so you can shop for something more realistic to the numbers that you can have.
Okay, that's awesome. Yeah, no, because this happens all the time, right? I mean, I'm sure you see this all the time. I want to upgrade my house, and I have this house, and where do I go from here?
True. And at this point, again, it's best to visit professional person in financing, or mortgage specialist, because we're gonna look at both situation. We encounter both scenarios and give you the best advice we can.
That's awesome. So I got a couple questions here. We did some polling on Instagram, and these were some questions that some of my friends, some of my clients had asked. So the first one we have here is from Graham. So he was asking, what is the best way to structure a mortgage plus improvements? So I'm assuming he's maybe buying something and he wants to maybe renovate a kitchen and do some stuff in there.
Yeah, well, that's a great question, Graham. I hope you're listening to this conversation. But mortgage plus improvement is always, insured by CMHC normally, and as long as the improvement doesn't exceed certain limit, so it's not major improvement. Because if major improvement, then we're looking here at the construction mortgage, withdraw mortgage, and it gets complicated. But if it's only mortgage plus improvement, for minimum improvement up to 10% of the purchase price or maximum 40,000, whichever comes first. We do the approval, ask for quote on the property that he's gonna buy, what kind of improvement they want to do, and those has to be like really a structural improvement, not cosmetic, meaning paints or curtains or putting maybe a mini bar in the basement. All those kind of add value to the property. They're looking at like plumbing, roof, flooring, like electricity. All those will add value to the property. We got a quote. We look at those. If the quote is fair, we add it to the price of the property and we approve the client on that base. Now, I think very important to know, when the bank advance the money, they're gonna advance the money based on the purchase price, and put on hold the improvement money. Why? Because at that point, the property worth only what you're buying without the improvement. And because the bank cannot force you to do the improvement, they're not going to hand you the money first. They're going to do the improvement. Once the improvement is done, there is a form to sign between you and the contractor and the bank to make sure that the work is done. We ask for receipts, and then we can release the funds within like 48 to 72 hours. But most contractors would take, when they know you're approved, they will take that deposit and do the work and get paid after.
Okay. So basically, like, let's just say I called XYZ Home Renos and the job was, $30,000. So they finished the job, and then would RBC just send the contractor the money, or would they send it to the homeowner, or how does that look?
Very smart question. The money is always traded between lawyers and the banks. We never go to the client or to the contractor. We send it to the lawyer, will hand it to them after, we got that form. So everything to the lawyer, because now the lawyer has to register the new amount of money on top of the previous registration.
Now, this question is something else, but I'm just thinking here, a lot of people are doing the refinance. Where do you see that going? Like, you're not going to be able to refinance everything for forever, but, if the market keeps kind of going up.
Well, normally people would refinance for multiple reasons. The most common reasons we're seeing right now, one, people incurred lots of debt because loss of employment or, loss of income because of COVID and laid off and all this stuff. Now, if they have equity in their house, they refinance to get some money back from their house to pay some debt, higher interest debt. And that's very common and very realistic and very actually, advisable to do, because you don't want to keep so many trades with higher interest debt against you while you have enough equity in your house to pay that off. So that's the most common reason. And especially if you are with a bank, you can move to a different financial institution to do that. And with RBC, as I said, as long as the mortgage is over 100,000, we cover most of the cost except the penalty. Okay.
Right.
The other reason, as I see right now, very common, people have properties they have equity in, and they want to buy another property to invest, but they don't have cash liquid for down payment. Okay? So what they do, they do the refinance on one property, okay, to get liquid money out of it. We call it liquidate that property, get enough that property to use it as a down payment to purchase another property, or stock in the market, which is, I don't leverage real estate to invest in the market personally, but again, that's up to the advisors of investment and stock market to give them those advices.
Right. Okay. So the next question we got here is from Bethany. So her question is, do you have any tips, Mike, on getting pre-approved for a mortgage if you are self-employed?
Yeah, there is a few tips actually, because self-employed people normally tend to claim lesser income, okay, on their income tax, so to speak, taxable income. So what we look at to qualify the client, whether they're self-employed or commission employee, or they rely a lot on bonus, we look at the last 3 years average, or the last year, whichever is greater. But what we look at, the taxable income, line 150, how much you're 15,000 now, how much you're paying yourself if you're incorporated, and if you're not incorporated, you're sole proprietor. We look at how much money you're paying yourself, and we can gross it up by 15%. If that income is sufficient to qualify you, great. You'll be treated like any person in the market for down for source of down payment and everything else. However, if the income is very low, which is, I think that's what Bethany is referring to, we're allowed to use a stated income. Stated income means inflated income, not what we're showing on taxable income. However, stated income, we need to make a good, strong business case to see how the business is doing. The client good credit. So if you don't have good credit, the first step would be start working on your credit to improve them, because in order to be able to use a stated income, we need clean credit, good credit. Also for down payment, if we're using stated income, as I mentioned before, we cannot use gifted funds for down payment. It has to be from own sources. And the reason for that, because the lender wants to make sure that business is doing well, so you are able to save money for down payment before they come to a mortgage. Okay, so that's why it's so important. Also, we look at the gross sale of the company. Lots of times the people, would have a gross sale, but they don't show it even on their income tax. We need a business case to show cash saving, good credit, what the client financial status, and how we can verify or state that the client is making more what actually we're seeing on the income tax. Okay. Those are some good tips. Yeah, because I know I get that question a lot too. And obviously I'm self-employed as well. So me personally, I'm waiting for my 2 years. My 2 years will be this September. And then I think, I might be able to go with an A lender or someone as opposed to a B or private. That's a very good point. However, lots of times, especially with real estate, when we see the real estate market right now, everybody in Canada knows real estate is booming. It's like when a nurse just started working and still under probation, can we use her income or not? Most time, likely yes, because the likelihood of a nurse to keep going with their employment is very high because of the demand. Same with real estate. We look at the real estate, even if you have 1 year of full, income, and look at your year-to-date commission. If it shows that how much income we can use, we can get exceptions. So basically, when we talk about rules and regulations, that's what to talk about. However, every situation has exceptions. And in this case, as a realtor right now, everybody knows how the market going. So that could be possible based on the business case that we make. Okay, cool. I'll have to think about some of that for myself then. That's awesome. So yeah, the next question we got, this one's from Lacey. So is it possible to still get approved for a mortgage with school debt? So I'm a millennial, and I mean, most of my friends have school debt. How does that look, Mike? And I know it can be tricky sometimes. That's a good question, Lacey. That's why normally I would approach mortgage person, because you know what, we don't at RBC anyways. We don't look at only how we can approve you. We look at the other side of the financial sheet and try to help you setting yourself to be approved in the future. So it's not one touch. You can be approved. No, you can't be approved. Sorry. Okay, we can tell you to be approved. Now, when there is lots of student debt, it's all gonna depend on how much income we have on the table here, because there is a debt servicing ratio, income versus expenses, to see if the client can qualify for. After all, when we try to do an application for the client, we don't want to put them in financial hardship or difficulties that they cannot afford what they have.
Right.
They can borrow. That's why we look at those pictures. Okay. But if the income is sufficient, then yeah, why not? It's not because you have a higher debt as a student, now you can't qualify just for that fact. As long if the income is sufficient, then yes. If the income is not, maybe we'll give you an advice what you need to do with your debt, how you need to pay it faster, and maybe consolidate some of it to a secure line, not secure, to a loan,
Okay.
and get one payment. So we have lots of ways of approaching this, but not every situation is going to work. However, when you do that meeting, we're going to tell you when you're going to be ready to do it.
Yeah. So it's almost like, yes, like Lacey or whoever has, school debt should link up with someone like you, Mike, start the process today, and you guys will basically work with that person, until eventually they buy a house.
Absolutely, we do.
That's awesome. That's awesome. So the next one I have here, this is from Maurizio in my office. So he says, I just started a new job. Will I get approved? I have money for a down payment. So I suppose it depends what kind of, down payment they have. Maybe if it's 20%, it might be easier.
No, not actually, this is very, very good question. And I just prematurely gave you a tip about the nurses. Okay.
Right.
Again, Mauricio, there is two ways of looking at the employment. We look at the job tenure. If the person has been in the job long enough, past probation, and we have income, okay, to evaluate the situation with good credit, good reputation, and the field of work. Okay, it's very important. Secondly, lots of times recently, if somebody graduate as an engineer or as a lawyer and just start employment in the same field, we're not going to wait that person have 2 years on hand or a year on hand. We're going to look at it right away. And in certain fields, like the health field right now, even before they pass probation, when they have letter of employment, guaranteed number of hours, most of the times we're accepting that. Okay?
Wow.
Before they pass probation, because the likelihood of that field to be continuous employment is very high. And I haven't seen any nurse applying for a job and not getting it in this time. So I'm giving the nurses example because I have tons of respect for them, the essential work that they do, and hat down to all these people that risk their life for us. I consider them like the white soldiers,
they are
the green soldiers who are on the, on the borders, and these soldiers on the borders with those disease and pandemic. That's why I like always mentioning the nurses, because again, tons of respect for them. Salute them.
Yeah. No, they've worked so hard over the last year or so, right, with the pandemic, and some of my family members are nurses in healthcare, and yeah, I know how hard they work and the hours, and it's crazy. So that's awesome that you guys are able to help them out.
Absolutely, and as I said, we look at them differently, and I don't want to specify only all the medical field guys. Okay, so not only the nurses. So I don't want to be really kind of targeting only special group. So all the people who are working, so we can be safe. Tons of respect. Now go back to Mauricio's question again. Yes, and again, the best way to do it, do pre-approval, because if client just got a job right now, and I have a client actually who had a good job, was a software company, okay, as an engineer. He's software engineer, and just that he's going to take possession 2 weeks from now. He hasn't taken, and we got him approved.
That's awesome,
because it's the same field of of work. He's going for home improvement for income. So he's improving his position. Why should we take it as a negative? Okay, so that's why it depends on the situation, which job, what's the tenure. But if we look at somebody who changed 4 or 5 positions in the last year, and every position in different field, 2 months here, 2 months there, maybe that person doesn't like to work, or maybe they don't like him where he works. So that's why we have to look at the situation, but don't let that discourage you from approaching a mortgage specialist.
Right. So essentially, call Mike. Just get it started. You know what? Because you might be surprised, right?
Yeah, and at the end of the session, I'll give the people like our information, like contact information. Whoever wants to contact us, we work 7 days, and late hours, as you notice, like
Yeah.
we don't have weekends, but because we have to be working when people are looking for houses.
That's the way it goes. Yeah. So I got one last question here for you, Mike. So this question's from and the question is, how does lending work for someone who owns more than one property? Which I think we kind of touched on it a bit, but.
Well, I want to answer your question two ways. If that property is an investment property or principal residence, because every person is allowed to buy 1 or 2 or even 3 principal residence. Because as I was talking to Andrew before this, he was actually touching base on that question. If you have 2 jobs, one in Ottawa, one in Windsor, you're entitled to have 2 houses. Why not? And you can still go 5% down on each one of them, as long as the goal of the purchaser is to use it for principal residence, not investment. Now,
okay.
Again, you can buy 2 or 3 properties under that. Even if you want to buy second property for a family member that don't qualify for mortgage, but your financial situation would allow you to apply on their behalf, you can do that with still 5%. Again, as long as the purpose of
principal residence
is for principal residence. Now, if that property purchase is for investment, then yes, you can qualify for up to 5 investment properties, but the requirement is 20% down payment, and you have to qualify financially to support that property. We always use market rent, assuming what the rental income on that investment property will be, and we can add it to the income at RBC. Not all the financial institutions offer that.
Wow, cool. Yeah, because you know what? I never knew that you could hold up to 3 principal residences. Yeah, I think that's pretty cool.
Lots of people don't. Lots of people think when they sell their first property, they cannot go with 5% down payment, which is not true.
That's what everyone thinks, I think. Like, this is the first time I've ever heard of it.
Yeah. So maybe that's stopping lots of people from coming to us to buy houses.
It could be, yeah. No, but very cool. Very, very cool. Well, Mike, how, if someone wants to get in touch with your group, how do they get in touch with you and, maybe discuss this more in depth?
Well, my team is, I have 4 people on my team. Okay. And myself, my name is Mike Habib. I'm a senior mobile mortgage specialist at RBC. My phone number is 519-996-6085. My email address is MikhaEl, MIKHAEL .HABIB @rbc.com. My junior mortgage specialist on my team is Colin Bossy. He covers mainly the county and Windsor. Very cool individual, Colin Bossy. Okay, and we have 2 assistants. I call her, office manager, Beverly Sharon, 519-818-5121, and Michelle Habib. She's in charge of our marketing and social media and pipelines.
Good for you guys. So yeah, if you guys want to reach out to Mike, he's a great guy. Definitely super happy he came on the show today, and we'll have to do another one, Mike. I think you mentioned earlier there was a topic we were talking about is, why you should use a realtor, and I thought that would be a great topic for a whole different video.
Absolutely, and I think you should start it with that, Andrew. To be honest, because you're doing amazing. Since I've met you, I follow you on Instagram and Facebook. You're doing an amazing job, and we've done a couple of mutual clients, and they spoke very, very highly of you. So I'm going to recommend you to anybody I know, honestly. And you're working very, very hard for your clients, which they deserve to, but not everybody doing that. So
no.
Buy a house.
Well, I appreciate that, Mike. Well, so we've been going for about 44 minutes here, so we'll turn it off, and I'll let you start your weekend, maybe.
Thank you. Please email me the YouTube, so I can look at it. And it was great having this conversation with you. I wish everybody great luck, and please, everybody, stay safe.
Thank you so much, Mike. And for everyone watching, I'm going to make sure Mike's info is down below in the video. So if you guys do want to reach out to him or his team, you'll be able to do that.
Thanks, Andrew. Have a wonderful day.
Awesome. Thanks, Mike. Have a good one. Cheers.